Hi, everybody. We're back and we're working on some practice questions. We just had some time for the chapter 20 in-class group project, and now we're jumping to the part 2 of the chapter 21 notes. So you guys have some practice questions on there. We'll go through them in about 3 minutes. And then we'll talk about the confusing and painful world of error correction. Okay, let's go ahead and go through these now. First one says an example of a correction of an error in a previously issued financial statements change is a change. And so it would be a change in accounting principles if you just switched from GAAP approved to GAAP approved. But it's a change in or a correction of error when you go from something that is not GAAP approved to something that is GAAP approved. So that answer is C. A significant misclassification of accounts receivable on the balance sheet would be an example of an accounting error requiring a prior period adjustment and restatement. Okay. Number 3, the accountant for Mission Inc. realized depreciation has not been recorded on an asset put into production at the beginning of 2025. It is now the end of 2026. Correcting this error will require a prior period adjustment to, and so this is retained earnings for the adjusted amount. We wouldn't debit accumulated depreciation, right? Because they didn't record it. That would be the case if we needed to, if they over-recorded it. When correcting a change due to an error, the restatement approach employed by, and so here we're looking at correcting all prior period statements presented. Number 5, if at the end of a period, a company using perpetual inventory erroneously excluded some goods from its ending inventory and also erroneously did not record the purchase of these goods in the accounting record, this answer would be no effect on net income, working capital, and retained earnings. So our answers are C, A, D, A, and C. Okay, so I tried to make this so that you could use it kind of as a tool while you're doing the test in part of your notes, and I put in here kind of some of the examples. When we're talking about correction of errors, the discovery of an error, the company must correct the error, and then you can put a little note here, unless the error is not material. Remember that all of our revenue and expense accounts get closed into the income summary and then into retained earnings. So if there's a mistake in that, it's going to get closed to retained earnings. If it's a balance sheet account, then we have to adjust the balance sheet account. So the correcting a journal entry also adjusts assets and liability accounts that are impacted by the error. And this should be if the company presents comparative financials, it should restate the prior statements affected by the error. So most of the time we wouldn't worry about it. We would just make the entry to say depreciation and kind of move on. But if you're presenting things comparatively, you have to make the correction in the prior year statements. Restatement is used for the process of revising previously issued financial statements. The term distinguishes an error correction versus a change in principle which is called recast or revise. So let's look at example 1. So I've started to do these, and I really struggle in my head with when they have 2 years and they kind of ask you for the last year. So what I promise you is on your exam, I will only focus on questions like this where they talk about 1 year, because they just take too long to figure out and they're too hard to keep in your head during an exam. Now you'll probably have a group project in classwork that'll be a little more comprehensive so you understand how to do it. But I don't want to put you in on the test and say, figure out what 2 years is. You got 10 minutes to do this question. So, because this is terrible. And I'll be honest, I just can't keep it in my head, even though I know if you overstate this, you understate this, if that affects that, there's just so much here going on. But these ones that are shorter are nice, okay? So assume that the 2023 errors were not corrected and that no errors occurred in 2022. By what amount would the 2023 income before taxes be overstated or understated? And so here we're looking at this and we've got 50,000 overstatement plus a 20,000 understatement. And now here you have to say, well, what happened? So if we overstate our ending inventory, how does that affect our net income? By overstating your inventory, it understates your cost of goods sold. And so your net income is overstated. And this understatement here, depreciation expense, the 20,000 understatement also overstates net income. So here you have a 70,000 overstatement. So the answer is A. So you have to think about how each of these affects either retained earnings or, in this case, net income. Example 2. On January 1, 2025, Finch Industries properly reported 200,000 of supplies inventory. In 2025, Finch purchased 1.3 million of supplies. December 31st, Finch neglected to adjust the supplies inventory. Supplies on hand totaled 1,225,000. So that's a lot of supplies on hand. So what should have been reported in supplies expense? So we have the beginning balance. And that was 200,000. We add our purchases. 1.3 million. And so total available supplies, 1,500,000. And then our ending balance is 1,225,000. So supplies used equals the difference, 275,000. Any questions? Okay. Let's take a look at example number 3. In 2025, Regner Company discovered an error while preparing its 2025 financial statements. A building constructed in 2024 costing 1.2 million had not been depreciated. The estimated useful life of the building is 30 years with no salvage value. Straight line depreciation is used. Regner did include depreciation on their tax return, also using straight line depreciation, so there's no taxable differences. Income tax payable was also reported correctly at a tax rate of 25%. Income before depreciation in 2025 was 300,000. What was the impact on the following accounts at the start of 2025? So we have to calculate depreciation expense. And so that would be 1.2 million divided by 30. And so that's 40,000 per year. So that tells us that it's either B, C, or D. And so we got to go and figure out the next part. And so retained earnings would be affected by 40,000 times 1 minus the tax rate, which is 0.25, which equals 30,000. And so our answer here is C. Now you guys get a practice one. Give you guys about 3 minutes and then we'll come back. Everybody ready? Okay, so there's a couple of things here that you have to read this question carefully for, because this one says income before tax and depreciation. But here it asks you about net income. And so we don't have net income showing anywhere. So what we have to do is figure out the depreciation expense. And we already know that it's 1.2 million divided by, what did we say, it was 40 or 30 years? 30 years. And so that equals 40,000. So income before tax and depreciation equals 300,000 less depreciation. So 40,000 gives us income before tax they actually will call it EBIT. So that's the term that you've heard before, EBIT, and EBITDA, which is earnings before income, tax, depreciation, and amortization. That's what this would be called normally. So this would be EBITDA or something like AT, something like that. And then this one would be EBIT. So this is 260,000, and then your tax 25%, which I believe is 65,000. And then, so your net income would be 195,000. Now you guys got the second practice question? And again, we know depreciation expense is equal to 40,000 per year. So your depreciation expense is 40,000 per year. 40,000 times 1 minus the tax rate of 0.25 equals 30,000. And so we would have a $30,000 adjustment to the beginning balance in retained earnings. So my understanding is the entry would be debit retained earnings, because this is bringing your retained earnings down because you didn't record the entry. And so this would be 30,000. And then you'd have a credit to accumulated depreciation for 40,000. And so I think you'd have an income tax payable as a debit for the difference of 10,000. Okay. All right. Understanding error analysis. So companies do not correct immaterial errors. Defining materiality is, of course, difficult, and when managers and auditors must use experience and judgment to determine whether it's necessary for a given answer. So they've got to answer these 3 questions, which I deleted off my answer sheet, so I have no idea what they are. You'd think I do a lot more drinking for the way my brain freezes. Yeah, exactly. Do that one. I accounted for that one. I don't know where I pulled that from. Gotta be in 21.4. Oh, there we go. There. So forgive my brain cramp there. And so what type of error is involved? What entries are needed to correct for the problem? And then after discovery, how are financial statements to be restated? Okay, so now I put some of this information in here for you. I can't keep all of these things in my head, and I wouldn't certainly expect you to. This process is really very challenging. And so I want to take some time and kind of walk through each of these with you, but it's going to take a little more time than we got today. So we're going to wrap this up on Tuesday. And like I said, I'll give you guys about 5 minutes to do the project, and then we'll complete this and we'll pick up here before example 4 on Tuesday. Okay. If you don't have any questions, you all are free to go. Thank you and have a great weekend.